Welcome, everybody. Welcome to our 20th annual Outlook. We're really excited to have you all here. I want to just start off, first and foremost, thanking our sponsors that help make all of this happen. We have 4 presenting sponsors, and for everybody that's here, if you want to meet anybody afterwards, the presenting sponsors tables are up front here. We will have a reception afterwards, so make sure you say hello, and we appreciate all the business these great companies do. Gibbons Pursley, Washington Trust Bank, Land Pro Data, and Serve Pro are our 4 presenting sponsors, as well as our co-sponsors, A10 Capital, Bus Mechanical Services, Centimark, Crane Alarm, Cutting Edge, Infinity Signs, Syringa Networks, and TradeStar Construction. And a lot of these companies that you see are companies that Colliers does a lot of work with throughout the year, particularly on our property management division, taking care of many of our properties across the state. So nice round of applause for all of our sponsors, and thank you for them. I'd also like to welcome and acknowledge any elected officials that are here. And I know that we've got a number of people that have RSVP'd. I didn't get a chance to see everybody, but I know that both Mayor McLean and Mayor Simison from Meridian are here. Thank you for coming. Mayor Kling from Nampa, I believe, is tuned in virtually. So I'll wave to the camera to Mayor Kling and welcome her. Also, for those of you who were here last year, Hope Morrow from INL, who was one of our speakers, is back this year. So welcome back, Hope. We're excited to have you here. As always, we have a lot of folks that are watching this virtually. I shouldn't say as always, for the past 3 years, since the pandemic year of Outlook, when it was all virtual, we've been able to grab a lot of people around the country, a lot of different Colliers offices and clients who aren't here. So welcome to everybody that is watching virtually. And I should have asked for some assistance, but does this advance the screen, Amy? Is this what the big green button? All right. There we go. What a year 2023 has been. If you remember, we wrapped up the conference last year, and I think I remember saying something about choppy waters ahead and how I was excited, though, to be in Idaho, that in navigating those waters, that, you know, this is the place that we'd want to be. And certainly we've had those choppy waters. We've seen a lot happen economically. Slowdowns do happen. That's you know, part of what we deal with year to year. We've had such a great run of years, and this was bound to happen, particularly following the pandemic and everything that threw at us. But I would say that we're still very excited. At Colliers, we're still very excited. We think there's a long runway ahead in Idaho, Treasure Valley, and across the state. A lot of opportunities. We're starting to see some things turn and change for the better, and we're going to talk about that today. We're really excited about our keynote speaker, Skip Oppenheimer, and I will get into a little more detail on Skip and what he will be talking about. But you know, I think it's important. We all hear about interest rates and recessions and all kinds of information. And as everybody knows, we live in a pretty volatile society right now. A lot of elevated opinions. A lot of people grab onto different sound bites and misinformation. I think it's, at least for me, I think it's fascinating when good news is bad news and bad news is good news. You know, we have job growth. That's terrible. Right? We hear about something great. The last quarter we had in excess of 4% growth in the economy, but that causes concern because of inflation and interest rates and what might happen. And I think what's really important is to understand the fundamentals, and part of what Skip's going to talk about today is a lot of those fundamentals, what the Fed Reserve does, who the Fed Reserve is. I do want to point out that Skip does vote every 2 weeks on whether interest rates will be raised or not. He's one of the influencers. He will not give you any inside insider trading, inside information today. He's not going to let you know what is coming from the Fed. He's going to talk more about what the Fed does, how they make the decisions, and how they influence a lot of what we do in commercial real estate. I think it's also important, as I mentioned before about economic slowdowns, we've had, I believe, depending on what you read, but we've had 11 recessions since 1948. So this isn't new. These cycles come and they go. Some are longer, some are deeper. But it's important to understand what causes them and the different influences so that we know where we're headed and we can give somewhat of an outlook, so to speak, for what's coming. And again, I don't want to steal Skip's thunder on about the Fed, but I would just remind everybody that we are a commercial real estate company. We're not here. This is not necessarily a political discussion, and I think a lot of what some of the misinformation with the Fed is understanding what they do. The Fed is in control of monetary policy. They are not in control of fiscal policy. So. The Fed sets interest rates, they manage money supply, they regulate, they have regulatory functions over financial markets. But where that money goes, where the government spends it, which programs it goes into, that has nothing to do with the Fed. They are handling the monetary policy. The Fed Reserve is, there's 12 reserve banks across the country in different districts. And I think one of the things, I know we always have questions submitted by folks, and there was a question about, the Fed being a for-profit company. The Fed's not a for-profit company. It's the 12 banks. In fact, after expenses are paid, any net earnings are turned over to the Treasury. And that's part of the setting the monetary policy that the Fed does. So with that, I'd like to introduce Skip and have Skip come on up. As I mentioned, Skip is chairman and CEO of the Oppenheimer Companies. He's a local developer, owner, operator of commercial real estate, so very familiar with our market. He chairs the San Francisco Bank Performance and Governance Committee as a member of the board of the San Francisco Federal Reserve Board. He's the incoming chair of the Bank Audit and Risk Management Committee for the Fed. And Skip is also heavily involved in our community. He's involved with Boise State, the Nature Conservancy, St. Luke's Health. Skip and I are on a board together with the Boise Contemporary Theater. We've gotten to know each other well through that. There's just so many different things that he does to impact our community here in the Treasure Valley in such a positive way. So without further ado, I'm going to welcome Skip Oppenheimer to the podium. And I will mention that when Skip is finished with his presentation, we will have time for just a couple, 3 questions directly to Skip before we move into our panel discussion.
Great. Thank you, Jim. Is this mic working okay? Everybody here all right? Yep. Great. Well, let me just first of all say how much I appreciate being offered the opportunity to be here today, particularly on the 20th anniversary of this conference. I've been coming, as of many of us, over many years and seen this grow, and I think it's one of the best conferences out there. And to be the keynote is a real honor. A little less of an honor, I will give you just one quick story. A few minutes ago, we were getting, this to give you an idea where keynote speakers kind of line up. We were getting mic'd up and we were standing in the back, and the AV crew here, as we all know, in fact, the whole, I think, Center on the Grove group does such a great job. But I was standing back there and they were putting mics on and they called, Jim Shipman, and they said mic number 2, and then George Iliff, mic number 1. And then I was standing there and they said, now who are you? And I said, I'm Skip Oppenheimer. And they said, don't have that name. Somebody said, well, he's the keynote. And they said, well, do you need a mic? I said, yeah, I think so. As far as I know, I think I need a mic. And somebody else in the back said, Well, I think we've got an extra mic in one of the drawers, if somebody can pick one up. So anyway, I just want you to know, I thought you should know that. Not to lower expectations of the keynote address, but just thought it was important you know that. But the idea of kind of where we're at, and Jim framed it, I think, really well. I thought what I'd do is maybe just give a little bit of background, and Jim did cover a few of the points, and I'll go through those fairly quickly. But I'd start with just a little background on the Fed, and then talk a little bit about, this is an Outlook conference, a little bit about the outlook and some of the sort of risks and challenges that might be out there, at least at the Fed and others, and probably all of us see. And then some of the opportunities and things as we get maybe down to the San Francisco district, which is the West, and then also a little bit about our local market. As Jim said, we've been active here for a lot of years. So a lot of people wonder, as candidly did I, what exactly does the Fed do? We always hear about interest rates. Is that all they do? Even that part of it's a little, I think, foggy. I felt like it was a little bit of a black hole when I first got involved. And it's hard to really know how they make their decisions and what these boards and staffs do and how do they come about making these, what are, I think we all recognize, decisions that impact all of us. They're important decisions. So I decided to summarize the decision-making process of the Fed in just one slide, which I'll now show you. Let's see here. Let me see if I can find the right. There it is. That's it. That sums up pretty much what I think you need to know. Thank you so much. And Jim, I'm available for questions. Well, based on that tepid response, maybe I'll go into a little more detail. The Fed basically is the central bank of the United States. It promotes the safety, the soundness, the stability of our nation's financial system. It was created and was mandated originally by Congress. They have a dual mandate, which I know most all of you have heard about, but it's really one of the things I think we all, rightly or wrongly, criticize a little bit, are some of our congressional activities that we all are witnessing. But one of the things that that the Congress did very well was in the 70s put together the dual mandate, which really focuses the activities of a pretty complex banking system at the central bank level and the district bank level. And that's the dual mandates. You can see on this slide a little bit of data that I'll come back to, but gives you an idea based on the dual mandate, which, as you can see here, is foster maximum employment, defined at 5%, and price stability targeted at 2% inflation. So that really is kind of the focus, overly simplistically, but it's an important element of what I think drives a lot of the activity of the bank. One of the impressions that I do want to mention when I first got involved, and again, like many of us, I didn't know exactly what either the Fed did or what to expect. I will say, and I think I can be objective, most everybody I know that's involved with the Fed feels this way. The people who work at the Federal Reserve are some of the smartest people I've met. They are some of the most dedicated. They literally, a lot of them could go to work for Goldman Sachs and make lots more money, and a few do. But the majority that dedicate their career to the Fed are so committed, they take their work so seriously, they know the impact of what they're doing is profound. So I just want to say, that was not exactly a surprise, but I think it's it's a good news piece of the puzzle that I found right off the bat. To go to a little bit of background, the Federal Reserve was started in 1913. It was signed into law by Woodrow Wilson. It created two pretty unique characteristics compared to other central banks around the world in that it's highly decentralized and it's also independent. And I want to talk just briefly about that independence and how political is the Federal Reserve in a couple of minutes. You can see on this slide the map, and Jim alluded to the point that there are 12 reserve districts. It's interesting as you look at this map to see in 1913 when they were established, literally, most everything happened east. There are only 4 of the districts that are west of the Mississippi. And you can see San Francisco is the largest. In those days, the whole West, as far as the composition of economic activity, it was pretty limited. The San Francisco Fed is the largest by geography. It's the most diverse of the 12 districts. It's the second largest by assets, but it's the largest by geography. The largest by assets is New York. It covers basically about 20% of the US economy. And so it's arguably, I'd say New York may be the most important. I'd say San Francisco is a very close second as far as influence within the Fed system. The leadership, Mary Daly, I don't know if many of you have heard her or know her story. She's the current president of the Fed. I immediately took a liking to her. For one thing, she's broken all the rules, and I'll go into a couple of minutes of detail on that. But she, for one thing, I liked her immediately because she's shorter than I am. There aren't that many people. That's why I like George Iliff, the minute I met him. But Mary, everybody seems to have gone to Harvard or Dartmouth or Yale or Stanford or, those kind of schools. Mary dropped out of high school and was out on her own at age 16 in St. Louis. She was working in a donut shop. Do many of you know her story? So she's working in a donut shop, dropped out of high school. She ends up apparently influenced by a regular customer at the donut shop in St. Louis, a woman who basically said, well, Mary, you seem like a really bright young woman. Why are you here? And Mary said, what do you mean, why am I here? I got a great job. I'm doing great. I'm on my own. I'm doing, what's wrong with this thing? And the woman said, well, I just think you could probably do more. This woman apparently influenced Mary. Mary then got her GED, went on to get a bachelor's from the University of Missouri. She got a master's from Illinois, and then she got her PhD from Syracuse, started at the lowest rung at the San Francisco Fed and in the research department, and ended up over time the head of research. When John Williams, I'll talk about in a second, who was the then president, went to New York, Mary applied, and there were like 100 in the kind of first cut, and then 12, and then ultimately the board selected Mary to be the president. And she, in my opinion, is this incredible leader, very committed to being out in the district, trying to get all these smart people, all this great data. She and the whole team are trying to get that more connected throughout the Western District to help drive that dual mandate that we talked about. So she loves Idaho too, by the way. And she comes, rather frequently. Some of you may have heard her speak when she's been here over the last few years, but she's a really interesting and very effective leader. She comes from a couple of people who were her immediate predecessors who were very effective. One is, I wonder, are we getting the slides up here? Can you see the slides? Yeah, there we go. So John Williams, I just mentioned, now the president of the New York Fed. The president of the New York Fed is also a permanent voting member of the FOMC, where the interest rates ultimately are decided. John, I got to know well when he was president of the San Francisco Fed. Is probably why I'm on the San Francisco Fed. He is an amazing leader as well. His predecessor was Janet Yellen. Of course, she's Secretary of the Treasury, formerly Chairman of the Federal Reserve. So the San Francisco Fed has had some pretty strong leaderships over the last bunch of years, and Mary's one of those. So let's now just talk a minute about the Federal Reserve duties. The point here I want just to make sure is clear, and Jim touched on this, is that monetary policy and interest rates is a very important part of what the Fed does. It's not all that the Fed does. There's a lot of other responsibilities. You can see them on here. I'm not going to read all of them. But basically, supporting the safety soundness of the financial system, making sure currency is available, the payments that are processed for the federal government go through the Fed, management of all the currency is under the Fed. They also play a very important regulatory supervisory role that's, as we all know, been in the news a lot with Silicon Valley Bank. I think they handled that very well, both at the Board of Governors level as well as at the district level as far as responding to that. But, and it was one other, we don't hear a lot of good news things about the federal government, but it was pretty amazing, for want of a better word, that over a weekend, the Federal Reserve, the Treasury Department, the FDIC, the State Department of Banking in California could all kind of come together and actually take action that quickly and agree on anything. I mean, that was a remarkable feat that served this country really well. So that regulatory, we could get into more detail if people want to, but how that works and what worked, what didn't work, we can talk more about if anybody wants to. But that's another function of the Fed, just to give you kind of a quick overview. And just so you know, there are 9 members of the Federal Reserve District Board in San Francisco and all the districts. There's 3 bankers elected by bankers, 3 non-bankers elected by bankers, and 3 at-large members appointed by the Board of Governors. So you've got 3 bankers on the board, and that affects how the regulatory work is structured, which I don't think we have time to get into today, but it puts most of that regulatory and supervisory role at the Board of Governors rather than at the district bank level, just to avoid the conflict that can come from bankers serving on the board, kind of understanding their competing banks' problems, which could create conflicts of interest. So that's just FYI. We'll get into a lot of detail on that. But the supervisory regulatory is an important element of the Federal Reserve's responsibilities. Jim had touched on some confusion sometimes, I think, about the Fed being responsible for monetary policy, not fiscal policy. The spending, the bulk of the deficits, the things a lot of us worry about, that comes through Congress, that comes through the executive branches, not through the Federal Reserve, just so that is clear. The fiscal policy, I think Jim touched on this a little bit, that's basically the tax policy, spending policies of the federal government. Again, that comes through Congress, that comes through the administration, not through the Federal Reserve. Federal Reserve relates to the things I talked about, plus, huge amount of their impact and responsibility is the interest rates and setting interest rates. They influence interest rates, not just by setting the interest rates, but also through forward guidance. When you hear Chair Powell speaking in front of Congress saying, I think we're headed this direction or that direction, and you have other speakers, including the presidents of the district banks out there talking, they're setting certain levels of expectations, and they call it forward guidance to give people sort of a preview of where the world might be going. But as Jim said, they're pretty careful not to give any absolute predictions. But that's a way of influencing people's expectations, and that can drive interest rates. And also the balance sheet, we hear the word quantitative easing, adding or subtracting to or from the money supply, another way of impacting interest rates. Those are just some of the ways that the Fed influences interest rates. But bottom line point here is Fed has monetary policy, not fiscal policy, and sometimes that's a little confused. The other, I think, important point that I wanted to share is that because this also has been in the news a lot, Fed is independent. And you can see some of the functions on this next slide of how does that independence manifest itself? Well, number one, the Fed doesn't rely on any appropriations from Congress or anywhere else. They generate the funds that they use to operate and to do their functions through fees, interest on deposits, that sort of thing. but they're totally independent. They don't rely at all on any kind of appropriations from Congress. The decisions are not ratified by Congress or the White House. The Fed governors are all appointed to long terms, like 14 years, which again, they're not worried about their job, next year kind of thing, unless they're at the very end of their terms. And the Fed presidents are appointed by the bank directors, the district banks, those of us on the district banks, for 5-year terms. So that kind of helps keep that independence alive and well, in my opinion, in my experience. They're within government in that they were established by Congress. They report regularly to Congress. You see various presidents and you see Chairman Powell and others, speaking before the Senate or the House, though that is within government. And the ultimate confirmation of the Fed governors is confirmed by the Senate. One of our recent presidents, other presidents, other political people have sometimes been vocal and pushed hard on Chair Powell and former chairs and members of the Fed. But again, my experience is, based on the meetings I've been involved for about 7 years, I believe it really has an independence. And people say, well, there must be a lot of political pressure. And I think to the extent that somebody is going to be the chair of the Fed, there's got to be some political, maybe calculation somewhere in there. But once they're appointed, I got to say, and I don't think this is an overstatement, not one board meeting that I have ever been in have anything political ever been brought up. It just gets, literally, the meetings are about the dual mandate, and they're about what's best for the economy. And I have not seen one political discussion in any board meeting that I've ever been involved in, which I think is sort of a affirming thought in this crazy world we're in. And I don't think that's an exaggeration. So those are just a few of the, at least, perceptions from one person's point of view that I've seen, and a little bit of background. But maybe enough about the background. We'll move on now to a little bit. This is the Colliers Outlook Conference. So let's move on and talk a little bit about where the economy might be going, how that affects all of us in commercial real estate. I think one of the real questions on all of our minds, obviously, is, are we going into a deep recession? Are we going into a recession? Are we going to have a soft landing? And as Jim said, I'm not here, nor can I try to predict, nor I'm not right anyway, 99% of the time, so it isn't worth much. But the good news is, and I think we've seen this, inflation gains have slowed markedly from the 40-year highs recorded last year. And as you can see on this slide on the far right, this is the Fed funds history. The Fed raised the Fed funds rate by 525 points starting in June of 22. You can also see on this slide on the far right. That was the highest level it's been, as you can also see on here, in 22 years, since 2001. We're seeing the effects, clearly, of the tightening of the economy. The good news is that the decline in inflation has come so far without significant deterioration in the economic growth of the labor market. The fears of inflation may be shifting to hopes for a more soft landing. If you listen to Chair Powell's comments last week, and it was Thursday, the message was, we may be seeing these higher rates for longer, but this is a time, and it may be weeks, could be months, this could be a time for a pause and to let this 525 basis point increase in Fed funds rate work its way through the system, and let's kind of step back and watch and see where that plays out. He didn't sound like there were going to be drops in rates. He didn't sound like they're meeting again next week, necessarily increases in rates. But again, that can change meeting to meeting. And one of the messages that I think Chair Powell has made over and over again is, this is such a dynamic time, and there's not a lot of models for pandemics. There's not a lot of models for pandemics combined with war in the Ukraine, et cetera, all these other challenges that we're facing. So the message is things can change, and it's important that the Fed be agile and be open to that kind of change. Mary Daly also made similar comments last week. If you happen to listen to her, she talked about vigilance, she talked about agility, but everybody agrees that we aren't there yet as far as getting inflation under control. The Department of Commerce, I think yesterday, or it came out this morning, released the growth rates in the GDP, which were still very strong, very robust. Unemployment is basically below target, which we say is good news in a lot of ways, that strong job market, but it's not good news when you're trying to get inflation under control. So there's some work to do on the unemployment side, and inflation continues to be higher than the target, as we talked about the dual mandate, which is that 2% number that we talked about. And both Chair Powell, President Daly, everybody literally in the Fed has, at this point in time, recommitted to that 2% target. You can argue that, but we're not changing the target in the middle of a very dynamic time with a lot of uncertainty. The other thing is, for all of us in real estate, the 10-year treasuries, as we all know, are close to 5%. That's the first time they've been that high in 16 years. That affects all of us, as we know. Mortgage rates and everything else is affected. We've all seen where mortgage rates are going. But the good news is things appear to be, at least to date, moving in the right direction in terms of inflation and employment, which we think is good news. And to punctuate that good trend just a little bit, this is a graph that shows CPI. You can see on the right, again, the far right-hand side of this chart, CPI in September was at 3.7%, which is far below the 9%, which you can see on here was recorded in June of 22. So again, the direction is encouraging. And it's worth noticing, as you look at the ups and downs on these charts, and Jim alluded to this too, every time we go through these downturn or these shocks, and you can see there's a bunch of them here, there's a tendency to say, well, things are fundamentally changed, the world's coming apart, how are we going to get through this? And it's very traumatic on so many levels, certainly the pandemic on every level. But all these shocks have been hard. It's hard to see the end of the tunnel, so to speak, and they all look kind of different. But ultimately, it's amazing how similar ultimately these are. And there is a resolution, and we do kind of come back as an economy. The key is, for all of us, obviously, is how do we navigate and how do we ride that cyclical wave and get through it. But you can see here the 80s recession, a big spike after that in the 80s. The early 90s was followed by a long period of economic growth. Then there was a tech bubble in 2000. 2008 had the Great Recession. Mid-March of 2020, of course, was COVID. And so we've been through a lot, but we get through it, and there is another day. And a lot of us just, how do we ride through that cycle? And although it's always a little different, it's not brand new totally, as this chart shows and as Jim also alluded to. And you can see these ups and downs. Here's another chart. Wait a minute. That's my EKG. Maybe we should disregard that one. I don't know. Actually, it may be relevant. That may have been, I think that, you look at the dates on that, that was actually my EKG while I was watching the interest rates go up and down. It actually, as you look at it, it's pretty steady. There's a few spikes up and down, but I made it through it, so I think we all can probably make it through it. What it doesn't show is that Doug was also holding my hand during some of that period. But maybe we probably should move on. I don't know how that got in there. Risks. I just wanted to touch on a couple of the risks that I think we're all aware of, but I thought it might be worth just punctuating. There's really 4 areas that the Fed's looking at, and they have a report that comes out, if you're interested, every 4 or 5 months that is called the Stability Report. Talks a little bit about where we're at in various aspects of the economy in terms of resilience and stability. It's online. There is a lot of good information, by the way, from the Fed for anybody that's interested. But I thought I'd just touch on a couple, just 2 of these that affect all of us in real estate. One is the asset valuations. I think we are all aware that the valuations are still fairly high. In talking with Colliers, some of the reasons for that is that there just haven't been a lot of transactions. People aren't selling at the same velocity and volume that they have in the past. And so there isn't a lot of great comps for cap rates. But because of the fact that there's high valuations, and there's high valuations on some of the bank, particularly regional bank balance sheets and concentrations, and this could have an effect on all of us as it relates to refis, and a lot of these real estate loans are coming due in the next 2 to 5 years, that could affect the underwriting and the kind of availability of funds potentially, particularly with some of these regional banks who have somewhat higher valued real estate assets that are coming due to be refinanced. And that's something I think we're all aware of, but something that we need to keep our eye on. The second one I wanted to talk about is leverage in the financial sector. The good news is that the banking system, by most all measurements, remains sound and resilient in terms of risk-based capital ratios. They remain close to the average levels over the past decade. Nonetheless, these high interest rates have continued to depress the value of longer maturity treasuries. We saw that with Silicon Valley Bank, who had a significant investment in long-term treasuries. That was only one of the reasons that they got into trouble. Same way with First Republic, same way with Signature. But it is something that, because some banks did take, when rates were low, a significant amount of their capital and invest those in long-term treasuries, which have gone down in value, that could affect, again, funding availability for loans, particularly in commercial real estate, that I think is another just thing to kind of keep our eye on that could affect all of us depending on how it plays out. But overall, when you look at all 4 of these risk factors, they seem to be generally in line with a couple of those exceptions I talked about with historic averages. But those are areas that, again, could affect the economy for all of us, but also all of us in commercial real estate. And just one more minute on the concentration. I thought this was interesting because if you look at California, you look at Washington, the concentration of commercial real estate loans is high in the West. Compared to at the bottom, you'll see the national average. You see that? And that's, again, even Idaho is higher than as far as amount of commercial real estate. That doesn't talk about quality, and a lot of these loans are very good quality, but it's just, again, something that could affect availability of funds, and there is a little more concentration than I was even aware of in terms of Western region banks that, again, could have some effect on us. And then I just wanted to turn just very quickly to the Western region and the 4 areas of commercial real estate that most of us are involved in. I just thought it was interesting. If you look at the blue, that's the Western region. This is absorption. If you look at the yellow, that's the national line on absorption rates. The takeaway here is that all the absorption rates, and this may be overly optimistic, but all of them literally move back to neutral or stay positive on forecast based on this data. And I don't want to go into detail here, we don't have the time, but both nationally and in our region over the next 1.5 or 2 years, we see at least a return to kind of a neutral, even in office, a neutral absorption rather than a negative absorption. And you can see, multifamily's been very strong, gets weaker, and that was somewhat slightly weaker and then back up, that gray being the projection. Retail looks stable and industrial, after being very strong, comes back to positive. So I just thought, that's another perspective. It's going to vary a lot by market. San Francisco and Los Angeles are going to be a lot different than Boise, but I just thought it was an interesting perspective just to look at, and trend-wise looks relatively positive. And lastly, just to wrap up, I wanted to talk just a little bit about it, and we'll get a lot more into this. The panel will get a lot more into this, but as in our local market. Just look at a couple of lines here. If you look at the green line, that's vacancy. This is multifamily in Boise, Idaho. The green is vacancy. And as you can see here, it's been very strong. The green line in 23 goes way up to basically reflect the amount of supply that's come on, if that's the blue bar. And the market's been so strong between 2017 and 2023, this is all from CoStar, that we just provided a lot of supply, and the vacancy rates went up to, it's about 10.5% in multifamily. Again, the panel may be closer to all this, get into more detail. That's well above the 7% national average. But you can see on these blue bars, supply is projected to slow down, and vacancy rates, that green line, come down as you look out into the future, into that between 23 and 27. And of course, that's affected rental rate growth and everything related to multifamily. But again, the good news is this looks like it kind of normalizes. One of the messages I think I would like to deliver is things do come back to a median, to a normal section. And then lastly, office. Again, this is for Boise. The takeaway here quickly is to look first at the yellow line. That's the national vacancy on office. And then look at the green line. That's the overall Boise vacancy. It's about 7%, well below the national average of 13.2%. So again, we're looking, this is good news, we're looking really strong. It also, the last takeaway on this would be that the orange line, which shows the mid and lower range properties, have higher vacancies than the higher end buildings. And I think that's consistent with the national trends in office, to the extent, there's a real crisis in office, but there's a flight more to quality, and this is happening also in Boise. And again, with limited new product being constructed, we may be relatively better than other markets. So to wrap up, I will just say that, we're probably as bullish on Boise as anybody. My brother Doug and I have been partners for almost 50 years. Doug is here, and we've been brothers even longer. We have had a lot of fun together. Those brother things can go a lot of different directions, but we've been very fortunate. He's also my closest friend and always has been, other than my wife Esther, who's also here. Jeremy Malone is here. There's a bunch of other of our team here, and we're just happy to have everybody with us. Kobe's here, and Sarah, Dana, and Lori I see here. But we're excited about Boise for all the reasons you all know. We've got 3 projects in the works in Idaho that we're excited about, and we can certainly talk more about that. And there'll be a lot more to come from the panel. But I just want to wrap up by saying we're very bullish on Boise. I think hopefully the takeaway of this is that the world will come back to some form of normalcy. It may not be tomorrow, but hopefully some of that data is helpful, and a little background on the Fed. Thank you so much for having me, and Jim, I'll turn it back to you.
When you're the leader of disaster cleanup and restoration, how do you make like it never even happened happen? Fire it up, Randy! By being prepared for anything! Let it rain, Randy! Whoa! Yes! Whoa!
you make like it never even happened.
Happen. Thanks, guys. See you tomorrow.
Serve Pro, like it never even happened.
All right. Well, I think we got out of order a little bit there for a second, but want to thank Skip. And we have time for a couple questions. If anybody has any direct questions for Skip, we will bring our panel up. And at the end, Skip will be joining the panel, and you can ask questions then as well. But if anybody had a question right now, we thought we'd give that opportunity. If you raise your hand, we can give you the mic. If you don't, here we go.
Thanks, Jim. Mr. Oppenheimer, how is the Federal Reserve involved in any trends towards digital currency for the U.S.?
Yeah, it's a very high profile and high on the radar screen item. You know, the whole question of digital currency, the whole idea of how the central banks in the world, every central bank fits into managing, regulating, being kind of in the same way that they handle the currency, being involved is a huge question. And so it's under a lot of scrutiny. There's no real answer at this moment as to whether what form or type of involvement will happen, but it's high on the radar screen. It's definitely something that is going to be, I'm sure, much more public as it kind of takes more shape and form, but it's not something that can be ignored. I think there's so many different ways to look at digital currency and all types of digital currency and ways of managing and regulating. It's going to be a while, but it'll definitely be something that we're all going to hear a lot more about. It's a good question.
Any other questions for Skip at this time?
Hello, my name is Ernesto Pinal with Rainbow International, and the question that I have is about, there has been in the news, and I follow this very, very closely, initiatives by other countries to create a common currency to substitute, at least partially, the US dollar for international transactions. How likely is that to happen, and what effects if that happens? And I think China is the main driver, and they could actually do it because of the fact that they are the factory of the world. And what effects will that have to the rest of us here in the States and in Western Europe?
Yeah, that's a really good question. The good news again on this is, at this point, the U.S. currency is the gold, quote, no pun intended, the gold standard. And part of that is based on the strength of the U.S. economy. China has a very regulated, as we know, currency. It's not a market-driven currency. And I think the confidence in the Chinese economy compared to the confidence in the U.S. economy today is significantly different in that the U.S. is significantly better. I think as long as we have a strong, stable economy and, you know, a political system that people think will sustain that kind of the capitalistic democratic society, and as long as that confidence is there, I don't see another country necessarily, at least in our life, certainly not in our lifetime, but or our kids' or grandkids' lifetime, I don't see any other country necessarily being able to take the place of the United States as sort of the standard currency-wise. You know, one of the issues, and this is on the fiscal side that I think we're all aware of, a lot of our debt is held by outside, you know, other countries, including China. And that can be good in the sense that it ties us together to some extent, but it's not good in the sense that we have, you know, a fairly significant part of our debt held by others. But again, as long as the confidence is there in our economic system, our currency is probably going to be the gold standard. The thing that would change that is if something dramatic happened to that confidence level. But at this point, I don't think Europe, I don't think Asia, China, Japan, I don't see any other countries that would have that depth of confidence in the economy and therefore in the currency that we enjoy today. But again, those things can be, over time, supplanted. And if you look at, China's got a lot of economic problems, as we all know. They're real, and we're all in real estate. The real estate world in China has changed pretty dramatically over the last few years. But they're going to continue to grow. They're just as you said, the size and scale of their economic, just the horsepower there is huge. But I think it all boils down to an overly simplistic statement, but it's confidence in the economy of the U.S. that will continue to allow our currency to be kind of the gold standard, in my opinion. Does that answer the question?
Thank you, Skip. We're going to hold any other questions and welcome our panel up. And then at the end, as I mentioned, there'll be time for more questions, and Skip will be joining the panel.
Great.
Thank you
Thanks,
so much,
Jim.
Skip. And I would just, I'd be remiss if I didn't mention how lucky we are. I don't think maybe it sinks in when you look at the largest district size-wise, and as far as the Federal Reserve, the Western District, and we're lucky enough to have a board member from Boise, Idaho. With all of the cities in the Western District, having that representation is so important, having a voice, and we're very lucky to have Skip Oppenheimer here and serving in that role and giving us that voice. And also just from a Colliers perspective, we're very lucky to have the Oppenheimer Companies. They're a client and good friends, so thank you. Thank you, Skip. With that, I'm going to welcome our Colliers panel up. I'll start by introducing each of them, and then we have a bit of a roundtable discussion. We'll have questions at the end. I would add that there is a number that you can text, 208-412-7288 if you have questions for the panel. So as they're speaking, if you come up with a question, you can text it, and that'll be relayed up to me so we can pass questions along. Also by having you text them, we can filter them if we need to. But so I'd like to welcome up the panel, starting from the far end here. Devin Ogden is an industrial agent with Colliers, has been with us a number of years. And I would also mention that NAIOP, which is one of the largest associations in commercial real estate across the country, opened a chapter here this year in Idaho. And Devin is on the board of NAIOP. And so if you have any questions on that, he's the one to direct it to later. But we're excited to have NAIOP involved here in the community. Mike Pena from our Canyon County office in Nampa. Tammy Walker from our Twin Falls office, Don Zebe from our Pocatello office, Brian Vaughn from the Boise office, who is focused in retail and multifamily, and someone you might have seen if you've been here before, George Iliff, longest standing member of Colliers here in Idaho, I believe.
Mike Christensen.
Oh, that's right, Mike Christensen. I didn't mean to overlook you. Mike is out there, and you might have an opportunity to see Mike a little bit later as we get going. But I want to just start off with the panel, and I think, as folks register and submit questions, I know that on a lot of the reason with Skip speaking on interest rates, there's a lot of question about interest rates and cap rates, what it's doing to our market, what we're seeing, what the impact is on commercial real estate as the interest rates have been rising. Now they may be leveling. So I just throw that out to the group. Brian, if you want to start us off and give some insights on what you're seeing.
Certainly. Obviously, like Skip kind of pointed out, we've been going through a period where interest rates have been rising, and that has been a pretty steady increase, not one that's had a lot of crystal ball to be able to kind of apply to it. And so we know cap rates are correlated to interest rates. They are not 100%. So while the interest rates have moved, cap rates have been slower to kind of move along with that. And large part of it is just that you have to have market transactions to really facilitate that. Most investors are not going to buy an asset where they're paying more theoretically in rate than they are actually going to be able to borrow against rates. So they need a positive spread to do that. But cap rates as a whole have definitely started to see that. Retail, which is an area I focus on, A lot of those cap rates were higher than, let's say, multifamily or industrial over the last few years. And so why there's been a drift there, we definitely haven't seen a dramatic drift. Multifamily is kind of the big question. Cap rates got compressed into a pretty low range as far as a number, high range as far as a cap rate's concerned. Some of the stuff that happened here in Boise had never been seen in the market, especially not for multifamily. And so that's going to have probably a little bit longer period for that transition for cap rates to kind of stabilize. But on the whole, I'd say most cap rates have probably moved at least 100 bips and will continue to slide. But we won't really truly kind of understand that until we have some stability in interest rates, and that seems to be kind of where we're coming as a period now. We don't think that the Fed will act too much more. It'll obviously react to events that happen, but once there's certainty that the Fed's not going to continue to raise, people will start to underwrite and start figuring things out. We've been in these points before in the past, and like Skip said, usually there's a brighter day if we just hold on. So
I'd just add too, overall, like you said, the overall transactions have dropped off year over year. If you look at the national numbers, transactions are down, sell transactions are down. It depends on the asset class. Like industrial is 47% less than we were last year. And it goes on up to 72%, I think, for multifamily. The number of transactions, we don't see that, but there's always that lag of interest rates rising, the cap rates are gonna follow a little bit after that. I'd say you talk about 100 basis points, I'd say kind of 100, 150. You don't see some transactions that are going on now or being discussed. They haven't happened, but it's, investors looking at it. It's, what was, people would have went all over it, a year ago, or now like, hey, there's not enough meat on the bone. That the cap rate has to be higher. There's more risk in it. And so I'm seeing that in all the conversations I'm having with investors on properties, it's the expectations are higher. It's meaning that the sell price needs to be lower.
Tammy, what are you seeing in Twin Falls? I know we're hearing from Brian and Devin here in the Treasure Valley. What are you seeing in the Magic Valley?
That's exactly what we're seeing as well. There's a lot of investors that are looking at the area, but they're also looking at those cap rates, and their price of money right now is going up, and they're just sitting back watching. Although we're working on one right now, so they're not dead for sure.
Don, similar in eastern Idaho, you tend not to see maybe quite as high the highs or low the lows, but...
Eastern Idaho is kind of a little bit of an anomaly in the fact that we don't see the high highs and we don't see the low lows. I kind of like to say that we're the secret of Idaho. We don't see that big influx and we don't see the low influx, right? We see that middle of the road scenario. We do have investments, but they're very strategic. And there's not a lot of construction going on. There's heavy demand for retail. The contractors and the developers are not building as much as they did in the past, so it's driving the rates up. So we're seeing an increase in being able to get higher rents in our market, and they're from national tenants. So we're seeing good things happen. Not as great as it was last year, but we don't see that high and low. So we're happy.
So Mike, I direct this to you. With interest rates are driving so much hesitation right now from the investment side, and I think it's interesting that our folks here are talking about cap rates at all. It's hard to know what a cap rate is if there's not a transaction actually happening. So hopefully we see that pick up and there's more comps to know where cap rates are. But that's, just like in the Great Recession, it takes sellers a while to come off of, well, my property was worth X just a year and a half ago, so it must be worth more now, and not recognizing that it's dropping. And vacancy rates, though, are still very low, so the demand is there. So, Mike, what's going to drive the movement on property sales, you think? What's it going to take to move that needle?
Right. Well, one of the things that always will drive a transaction, if there's a motivation point or a pain point for a seller. Right now, if a vacancy comes up, there's quite a bit of demand to fill that spot if it's a good property, and so we're leasing them up. So there's really not a pain point for the seller to want to make that transaction to happen. We have low vacancy here in the valley, but it's a hangover from the pandemic where we've had so many folks move into Idaho and the Treasure Valley that are taking this space. And there's not a lot of new product coming online too, which is adding to hold that low vacancy with high land costs, high construction costs, and construction interest rates. There's some hesitancy out there for new product to come online. I do think one thing that we're going to keep an eye on is most commercial loans are typically in that 5 to 7 years where there's a call. I've heard there's up to around $1.2 trillion worth of commercial-backed mortgage securities that will need to be refinanced over the next year. And that's going to cause some potential transactions to happen, because if you're refinancing and you have an interest rate with a 4 in front of it, and now you're trying to refinance and there's a 7 in front of that interest rate, it could cause them to have a cash call. I don't think it's going to be quite as bad in the Treasure Valley here because of our low vacancy. But if you look at some of the larger coastal cities where they may have a 25% office vacancy, that's another pain point that I think that we're going to see.
We also have the loan to values. It's like the interest rates have gone up too, but
Yep.
also there's the risk going into it. When they refinance, the loan to values are now lower than what they were 5 years ago. And so it's a significant cash call to come in. So I think that will be a pain point. But the other thing is why we haven't seen as many transactions is the taxes, right? People that own the real estate, if I sell my building now, where am I going to go with it? Where am I going to replace it on my down leg of a 1031? And that's limited a lot of people of their willingness to sell. They have to know where they're going with it.
Yeah. And most of the transactions we're seeing right now are for owner users that have been tenants, and now the prices have dropped a little bit, and so it's an opportunity for them to own the real estate, or they're 1031 or cash buyers. But we're not seeing a lot of investment properties happen that are being financed because cap rates are well below the cost of money, which is around 7.4% right now.
Another thing, sorry, Jim, just jump in too, just kind of follow up on, I mentioned before, and I'm more about the industrial side, but you talk about the price is not coming down. On a national level, there's 47% less sales transactions that has happened since last year, but the value of the value of the real estate has only gone down 3% from a year ago. And so the values are still holding there, for the most part. We'll see what happens when you get a little bit more pain points moving forward, but as of now, haven't dipped as much as you might think.
So on a brighter side, we started talking last year about Micron and the influence of their announcement. As we all may remember, it was not long before this conference I made the big announcement about their expansion. And I know we've had some activity, a lot of activity, revolving around that. So I'd just like to throw it out to anybody on the panel, what you've seen, the impact of the Micron expansion and new, whether it's new tenants or potential owner users coming to the market.
I guess I'll start off. The main thing with Micron is the construction of it, right? Both Micron and other large facilities that are being built around, right? So that's a lot of the contractors, all the subs, all the material, all that, there's a lot of transportation with all that. So all these companies are coming in to help with the construction of these large facilities. And so they're coming in and doing long-term leases, doing a 5-year lease, needing space for all the staging, because these projects are going to take, quite a few years to build. So that's the first wave. The next wave is when Micron gets up and running, is going to be all the service providers that are going to come and tag along with it and grow with Micron as they invest $15 billion in our market. But I think all those vendors are still figuring out, okay, what's their involvement with Micron's expansion, as far as Micron's commitment to them. So I think we'll see that in the coming years. But right now, a lot of it's just been more on the construction side.
I think the other thing that we need to look at is the long-term value that's going to be brought to real estate by the good jobs that this fabrication facility is bringing. So I'm going to throw a little plug out to College of Western Idaho. I'm the president of the foundation board and very fond of CWI. I think they're a real market disruptor in education. $139 a credit hour, whether it's for your traditional associate's degree or for CTE classes. But without CWI, I don't think the Micron fab would have happened because of the capability of training the citizens of Idaho. So I was a sales engineer in the semiconductor industry from 91 to 2003 before I got into real estate, so I'm real familiar with that. But typically Micron is going to recruit your material engineers and your chemical engineers nationally. But the semiconductor technicians, the folks that are working on the equipment, those usually come locally. And CWI and Micron have reached a partnership where we're going to be training those citizens here in our valley to have great jobs. And we're going to be training several hundred to 1,000 of those folks going through the megatronics program and the semiconductor technician program. So that good jobs, people are buying houses, they're going getting services and goods, office supplies, that sort of thing. So it's going to have a great impact on our valley for decades.
That was a really good commercial, Michael. Thank you.
Yeah. Thank you.
Yes.
Well, I need to speak
It's a
up about
volunteer
Eastern
job,
Idaho. I need to say something about Eastern Idaho. And,
Sure.
and there's some things that people may not be aware of, but the Department of Energy has got a project in Idaho Falls, Pocatello, and Blackfoot that has to do with the INL, the nuclear lab. They changed it to the Idaho National Laboratory. There's only 3 of them in the country. And over the next 5 years, they're going to be spending $3.2 billion in creating more opportunities in building of the nuclear lab that's out there in the Arco Desert. There's a lot of work that's going on inside of Idaho Falls. 30% of the population that works at INL live in Pocatello, which is a great thing. Idaho State University provides the students for that because they've got a nuclear program. So there are some really awesome things happening on the eastern side of the state, which you may not be aware of. And then the other thing that's the eastern side of the state's claim to fame is the FBI. There's only 3 facilities left in the United States, though you may not like what's going on with the FBI, and you may really like it. But if you've got a concealed weapons permit, it comes out of Pocatello. If you fly into any airport in the world, it's monitored out of Pocatello. And they've only got 3 facilities left that are really working in the United States. It's Huntsville, Alabama, Wheeling, West Virginia, and Pocatello. So there's some really good things happening there. They're closing down call centers, and they're not the call center that we're familiar with. It's an agent calling in, and that facility will be located in Pocatello as well. So there are some strong things happening, and because of that, we've got a deficiency in housing, like the rest of the state. And so if those are the kinds of things that are happening in the eastern part of the state. So we're creating good jobs. The average salary at INL is $108,000 a year. So if you want to take them from technology and move them into nuclear engineering, great opportunity.
But both of you brought up good points. The main pain point for any business, doesn't matter what asset class, what industry you're in, is labor. Mm-hmm. And you guys both talk, hey, great jobs, but it doesn't matter where you go, anyone you talk to, it's like, all right, that's great, you might have a facility there, but am I going to get employees? Right? I know some of the vendors will say Micron, like, hey, that's great, but okay, if I go there, where am I going to get employees? Because Micron's going to be hiring a bunch of employees, and they're similar type.
I think to speak to what all of you guys have set up here is that the colleges in Idaho are fantastic in partnering with the businesses that come in for the commercial side to put out amazing employees and give people a great place to work and live.
If you eat Chobani yogurt, it's coming out of Twin Falls.
From College of Southern Idaho, they train there. So the ISU, and I just think that the colleges are fantastic.
So a lot of good news coming. I mean, a lot of businesses, we talk about Micron, INL, the FBI, and I think, a few years ago, I remember standing up and reciting a number of statistics as to where Idaho is in the country in growth and different things. And Brian, as we were sitting over here earlier, mentioned an article that just recently came out. I thought, Brian, if you could touch on that, because we're not falling behind, it doesn't sound like.
Certainly, yeah. The U.S. News and World Report has us as the #1 growth economy, #1 in GDP for the foreseeable future. I think to follow on the heels of the conversation about education, and as long as I've been in the Valley, that's, to Devin's point, been people can't find an educated workforce. One of the stats that was in that report was that we're #3 right now for youth migration. That's something, as long as I lived here, I haven't really ever heard of as a stat to be associated with us. And so if we can educate a workforce here, but we can also move a workforce here that's younger in education, that's the kind of fuel that really adds fire to our economy. And so that's an exciting thing that I don't think that I've seen in the 22 years I've been in the Valley.
Yeah, the article is interesting, as you showed me. It's not only here, it's regional. Is number one in growth, number one in GDP. Number two was Utah, and both of those are neighbors just east. So this whole region still has a long way to go and a lot of opportunity. So I'm going to shift for a second. If we could turn Devin's microphone off, because I'm going to ask a question to George. And George, if you can answer this very quickly before Devin jumps in. But I think George, you might have been involved or lived through one prior recession. I mean, I mentioned since 1948, 11 of them. You've seen this before. You've been in the business. And real estate certainly is an industry that can be very cyclical with these, the upturns and the downturns. Can you just give some perspective on what you've seen and having been in other large cities and smaller cities? What's the outlook for Idaho, as we come out of this?
Well, thanks, Jim. For a minute there, I thought I was on the panel just as a pretty face. So I started in the business in 1970, but I was born in 45, so I guess I've technically been through 11 recessions. In 1970, I started in the business because I was hired as a stockbroker to start work, and they told me that I couldn't come to work because the Dow Jones had gone below 500. So from that, you look at the various recessions that have taken place. In 73 to 75, it was the oil embargo, and oil prices went through the roof. I had a 21% interest loan at that time, which was a lot of fun. In the 80-82 recession, inflation went to 15%, and it was a double dip recession, and the worst recession that we'd had since the Great Depression. In 1986, which I don't think is really counted as a recession, the Reagan tax law changed, TEFRA, eliminated a lot of depreciation, which caused depression. A lot of depreciation on real estate, and the market absolutely went in the tank. Savings and loans went bust. The RTC was created. Real estate, commercial real estate in particular, was 10 or 20 cents on the dollar as compared to what it was prior. It was a disaster from a real estate standpoint. From my perspective, worse than the 08 recession, because at that time on the commercial side, there was no business being done. I mean, there weren't lease transactions, sales transactions. The only transactions were the RTC taking properties from the failed S&Ls and selling them off over a period of time. So 91 was the Gulf War recession. 2001 was the dot-com recession, and I was in the Bay Area running the Colliers operation there, and that was the epicenter for that recession. And business literally stopped, and frankly, that's the reason I'm in Idaho, is because there just wasn't any business, and I had the opportunity to, along with others, buy the Colliers operation here at that time. The 08, 09, the Great Recession, it certainly was tough. Especially on the residential side, we managed to get through it on the commercial side, and again, it wasn't as bad, frankly, as the earlier recession. And then I guess we've had a COVID recession as well, which I think we've come out of, and we're not in a recession now, and I'm trying like hell to retire before the next one. So. But I also would give a little perspective on our market versus another market, if I can take a minute. So I have some colleagues still in San Francisco, and I was able to speak with one of them the other day about what's going on in the San Francisco market. So, and we're primarily talking about office, and you've all heard about what's going on there and the retail, the closing of centers and folks giving back properties to lenders and so forth. According to my colleague Tony Crossley, who's the top investment person in our office there, values have gone down 70% for office in that market, 70. And vacancy is north of 30, with substantially more shadow vacancy. coming. The market itself is 100 million square feet of office. About 30 million square feet of that is obsolete. Rents in Class B buildings are about $18 a square foot. And that sounds pretty low, but you also have to consider that triple nets in the city are somewhere between $35 and $50 a square foot, and that's taxes and so forth. Top rents in Class A buildings are still $70 to $90 a square foot. And my colleague says that it's a 5 to 10 year process to see any real progress in terms of change. The city has got a lot of structural issues it has to attack. So one piece of good news on this, if you're a broker, Tony just told me about a transaction that took place. It was a 40,000 square foot lease, and the owner, the landlord, ended up paying the broker $40 a square foot for the lease transaction. So the broker got paid $1.6 million on a 40,000 square foot deal. And landlords are now offering $5 per square foot per year for real estate leasing commissions. Wow. And that's on a market that used to be at $1. So it's a disaster in San Francisco. On the other hand, here in Boise, what we saw from Skip's slide and we know in our office here, downtown vacancy office-wise is close to 9%, and market-wise it's around 7%. So we're in such better shape than some of our counterparts in other communities.
Thank you, George. And I know, Devin, you've been feeling lonely down there since that was a full minute and a half. That you were not included. But so I'm going to shift directly to you. Last year we talked a lot about
I'm not talking anymore.
millions of square feet. Gosh, if that's all it took, Devin. Millions of square feet of industrial space coming online in the last 18 months, let's say. You know, we had a few years ago, all the industrial developers were buying land. Last year, a lot of construction. Where are we? What's being absorbed? What has been built? What are you seeing, and what do you see coming for the next year?
That's the popular question. I've been asked a lot the past 6 months to a year. But before I answer, I'll break it down for you. But just want to say one quick thing to what George was talking about. I was at a conference in Chicago, the real estate conference a couple weeks ago, and this session was talking about the San Francisco, Seattle's, New York's, where there's a lot of office vacancy. And the phrase came up, someone said, it's not that they're overbuilt in office, it's just that they're under demolished. Just kind of referring to like repurposing a lot of these office buildings.
Devin, getting you back on point on the question that was asked.
But, no, on the industrial, so this has come up, right? Everyone drives around, you see all the big industrial buildings going up. Say, hey, everyone knows there's a big wave of industrial properties hitting the market. So we track it. So buildings that have been completed this year or will be complete next year, they're currently under construction, right? We're tracking about 6.6 million square feet. That's done or going to be done next year. Of that 6.6 million, you have 2.4 million of it is already leased or pre-leased. So that's kind of taken off. So that takes us from the 6.6 down to the 4.4 million. And that's about 26 projects that total that amount. And of that, you got to contrast that with the tenants in the market. And we're tracking about 30 tenants in the market, sizable tenants, and that require about add them all together, they require about 3.5 million square feet, right? Not all of those are going to land, right? Some are looking at multiple states, different markets. Some might take less than what they're initially asking for. So if you figure a 65% conversion rate on that 3.5 million, that takes you, so 2.3 million of that is roughly going to land. And so that takes that mark of available product down to 1.9 million. So that's the number we're kind of looking at. That 1.9 million is what's going to be available to future tenants that come into the market, as well as other tenants that we're not tracking. So it's not as catastrophic as everyone thinks it is. Behind that, there's other projects that are planned, pre-planning, or targeting build-to-suits. So there's that kind of there as well. But you need to understand is like we've been at like a 2% vacancy, during this, the past several years. Now our vacancy, we're up. If you look at our market report, we're up at 6.8% vacancy. A normal healthy vacancy is like 7-8%. So we're kind of approaching what a normal healthy vacancy would be. I'd see that vacancy is going to go higher. I project that moving into next year, it's going to go higher, and my guess is we'll probably peak at vacancy, industrial vacancy, about this time next year as we kind of start absorbing all this product coming on, and then it'll kind of start tapering down as we don't have as many new starts going on right now. That will be that next wave coming in. So did that answer the question?
It does, and I think the important thing that you're alluding to there with why it's healthy is when you have a 2% vacancy, and I know we have some industrial developers and owners here, so I'm sorry to take the tenant side, but it tilts it very much in the landlord's favor. There's not very much negotiating by the tenant because there's no other space. So having that 6, 7, 8%,
it's hindered
kind of
companies
levels
from
the
growing.
field.
There's a lot of local companies have not been able to grow.
There's a lot of
space.
companies that have been wanting to come in the valley the last few years with that 2% vacancy. They're having to wait 2 years for that product to be available. So it is some of it is good to have some product available for companies looking to come in the valley.
Tammy, what are you seeing in the Magic Valley? I know driving down 84, you see there's a lot of industrial building going on. What's happening?
There is, but still in our market in the Magic Valley area, we're still under 1% vacancy rate in industrial. So there's about 640,000 square feet coming online that's permitted. It doesn't mean that it's going to be built, but it's permitted right now. But only 32,000 of it is going to come on this year, which most of the 640 is cross-dock. So it's really more of a user that doesn't help the small business people that we have in Twin Falls. So that we're still way under market on that and less than 1%.
Don, same thing in Eastern Idaho, or?
Not really. Because we get the influx from Utah, so most of that industrial is being done in the Layton area, clear up to the border. And then when it hits the border and comes up through Pocatello and Idaho Falls, we're not seeing a lot of industrial because they can take that southern route going into Boise and traveling that way into Salt Lake rather than coming up through there. But we're not seeing a lot. We have a vacancy rate of about 600,000 square feet, but that was built in 1944, okay? And it's still standing. That's where they took care of the guns from the battleships. And outside of that, there might be a total of 100,000 square feet vacant in Eastern Idaho. The last big deal that was done there was with Amazon and 110,000 square feet. But outside of that, there's a couple of 100,000 square feet that's being done by, trying to think of the name of the company, Melaleuca, but they have another company in there. They've got the largest beef packing plant in Idaho right now, and that's out west of Idaho Falls. But outside of that, we're not seeing a lot of industrial need, a little bit, but not a lot.
All right, shifting from one of the darlings of the market the past few years, the industrial, to multifamily, and I think for 2, 3, 4 years there, that's all we heard about is multifamily growth, and that kind of stopped, kind of changed this year. Brian, can you talk a little bit about where we are vacancy? I saw Skip had a 7% vacancy and how that the demand's going to increase. But what are you seeing as far as transactions and development?
Well, as far as development, I mean, there's an awful lot being constructed right now. I think that's the big thing that everybody's focused on is what is supply doing? It's softened, obviously, occupancy and increased vacancy. Rents aren't growing to the same extent, but you got to put that in perspective. We're not growing at 12 or 14%. We're growing at 3 or 4%. But there is a healthy supply coming on. And so I think we're going to be in a short-term kind of choppy waters. There's a number of projects that are planned that'll be interesting to see if they actually do pull the trigger and construct. Interest rates have obviously been the biggest driver of that. Construction costs, rose very quickly. Historically, in multifamily, if you're buying an existing asset, you're usually paying less than replacement costs. That's not common in a lot of the other asset classes, just because most people were saying, why would I buy something cheaper than I could, I mean, you would obviously buy something cheaper than you could build it for, but why would somebody sell it if they would in that position? But the reality is, if you look at the city of Boise's numbers, I mean, they feel that we need to hit 67,000 homes by 2030 of new supply. So we're talking, depending on who's calculating the multifamily, units between about 5,500 and 7,000. So that's healthy, right? That's more than 10% of that home supply. Single family is still building, so you got to put that in there. But there are a number of people that have those planned projects that are not going to go forward. So for the next 2 years, that supply will have a little bit of challenge for being absorbed. It will definitely push down further on that occupancy rate, will definitely keep pressure on rents. But ultimately, there's a lot of people that have just decided not to build. And so we're going to get to a point where all the supply is then supplied, and then you're going to see kind of an inverse. You're going to have probably more likely a strong demand with Micron getting closer to a fab. You're going to have just the natural growth rate that Boise's brought, and then a lack of supply. So where the renter right now is going out there and finding the newest product and saying, maybe I don't want to live in Meridian because I can now afford to live in downtown Boise, where a year ago I can't. They've got the pricing power. They can push the landlords on the rent. But eventually, as that supply that's brand new starts to tail off, it'll go the other way. People will then have to, again, see rents probably grow. And if you look at, kind of some of the longer range viewpoint, right now the median home price in Boise Ada County is $535,000 as of last month, which is only about $7,000 or $8,000 less than last year at this time. So we've seen the residential market somewhat find a floor and then come back up. So your average rent right now in Ada County is about $1,600, $1,700. Well, that $535,000 house is a $3,500 to $3,600 mortgage payment. So there is a big discount, or as we would call, a delta between those two numbers that means that there's a number of people that would probably like to buy but can't buy. So there is a renter out there that most people don't typically fashion or think of in the market. And so over time, that'll reverse its course. And I think that a number of these projects that are not going to go forward, they'll be rushing in 2 years.
I would agree with that. And the stat I saw recently is that if you take the average price of a home versus the average rent for an apartment, there's a 52% delta between the two in terms of cost to occupy. So multifamily is just for sure going to come back, and because of the affordability factor and our growth.
And I think with mortgage rates on single-family homes in around that 8% interest rate right now, we're seeing a drop in national new mortgage rate applications, and that people have to live somewhere. So I think it's probably going to drive folks towards multifamily temporarily until either pricing on the housing comes down or interest rates drop. But we're seeing in the multifamily developers that we work with is if it's a location and it's a developer that has a build and hold philosophy versus a flip, and it's a grade A location, they're still moving forward with the projects. And they're garden style type apartments. The podium style apartments, we've seen a lot of those go pencil down just because of the cost of concrete. It's been around $200 a yard. And with all the other pressures they have, it just doesn't make a lot of sense for those podium style developments to move forward.
Yeah, a number of contractors I've talked to, I mean, that's, if you were to price garden style last year at this time and this year, you're actually talking about a discount. So that's, from a development standpoint, it's been a long time since somebody could point to maybe a construction cost going down.
All right, with that, we are going to wrap up our panel discussion, and we're going to move to an opportunity for some questions and answers. I'm going to invite Skip back up to the stage here to take my spot, and also I think we have a word here from one of our sponsors, from Land Pro Data, while we get ready for some questions.
Land development professionals such as surveyors, engineers, planners, contractors, developers, attorneys, appraisers, title companies, and realtors need easy access to data starting with parcel information, subdivision plats, surveys. Knowing when an event occurs at City Council meetings is also useful. Land Pro Data collects the information and provides it in an easy-to-search and view format, so you can get what you need and do your work with confidence. And Land Pro Data can be wherever you are. in the office or standing in a field.
All right. I've got a few questions that have been submitted here that I'm going to give to the panel. And if you have other questions, we may have a moment to pass a microphone around. Don and Tammy, question for each of you, and you're both Magic Valley and Eastern Idaho. Are you seeing attention yet from national investors, or are you still in more of a regional or local investor environment in those areas?
I would say that we're still on the regional investor interest.
I concur. Very regional, local investors. We don't get very many nationals, well, zero nationals coming in to really look.
I think that answered that pretty clearly.
Yeah.
George, office. Everybody still asks, we had a pandemic, and are people getting back to the office? I want to remind you of where our office is, if you remember. Speaking of getting back to the office, but what are you seeing, as far as office trends right now? And we've talked a little bit about some of the other markets and in comparison to Boise.
I can still find the office because I own the building.
Oh.
You at least know where the rent checks come from.
Yeah, exactly.
Touche, our landlord.
Well, I think that people are coming back to the office, and I've spoken to some developers, some of whom are in the room, owners, office owners, and there's activity, there's demand. A couple of buildings are getting leased up pretty well. So, we're in a growth market, and Boise is not going to stop growing. So we may have some folks that shrink or downsize or what have you, or continue to allow folks to work from home. But I think overall, demand will improve, and there isn't anything on the horizon in terms of any significant office being built, at least in the downtown area. So I think I'm bullish on downtown. I think it'll continue to be strong and see good demand.
Just to add, in Canyon County, we're 2% vacancy in office. 2 quarters ago, we were 1.6% vacancy, which is the lowest it's ever been since we've been tracking it. So very healthy over there in the Canyon County area for office space.
Skip, question for you from the audience. The 2%, the dual mandate, and it talks about having inflation at 2%. What drives that, or do you see that changing at all? As we've seen interest rates drop, but they're certainly not interest rates, but inflation drop, but it's not at 2% yet.
Yeah, that's a good question. First of all, I don't see it changing. I think, there's been a lot of discussion, but at least in the near term, and I mentioned this briefly in the comments, Chair Powell made it very clear, even as recently as last Wednesday or Thursday, that to begin to change that dual mandate in the middle of a very uncertain climate would be a mistake, just as far as confidence. But even in spite of that, I think the leadership of the Fed has made it clear 2% is, at this point, the right number. Why is 2% the right number? It's kind of odd if you look back at the history. It was actually a number that came out of the New Zealand Central Bank years ago. And the reason it makes sense is that if you're under 2%, the cushion, if you have a shock or something goes haywire in the economy, you can more easily get to a negative interest rate, and that nobody wants that, and nobody wants negative, basically deflation. So this provides at least 2% cushion, which is part of the reason. Also, I think as we all saw, really low interest rates tied to really low inflation distorts behavior. There's probably overbuilding. Things happen that probably aren't the soundest. 2% seems to be the right number. If it's above 2%, then you have the issues that go with inflation, reduced purchasing power. You've got wage demands increasing substantially, wage demands going up, wages going up drives inflation. That continues to drive then higher inflation, and that reduces purchasing power, and that's what I think we all want to avoid. So 2% just seems to be that kind of sweet spot at this point, and I think we're going to see that for at least the foreseeable future.
All right, and one final question. I know questions, and we have one more announcement to make, but that's the last thing keeping you from your drinks and appetizers that we'll have following this. Throwing it out to the panel as a whole, I mean, I'm combining a couple questions here that were submitted by the audience. Where do you see the best opportunity in real estate in the next 2 to 3 years in the Treasure Valley and Idaho? And if you were an outside investor, where would you be pushing someone right now? What area is the best investment opportunity? And I know, Mike, you're going to say Nampa, and Tammy's going to say Twin Falls, and Don's going to say Eastern Idaho. But whether it's asset type or area of the state, what do folks think as far as the opportunities going forward right now?
I personally like smaller flex type industrial buildings. There's been a lot of industrial development done over the last couple of years, but we have not seen a lot of the smaller buildings be developed in the Treasure Valley where you have your contractors that need that 1,500 to 3,000 square foot space. So that's kind of a product that we still have a super high demand with. I bet we have less than 1% vacancy on that for those smaller products. So that's kind of where I'd go towards.
I would mirror that.
I was going to say, before he jumped in and cut me off, I was going to say the same thing.
That's never happened to you before.
Well, because that's an asset that's missing in all of Eastern Idaho. There is very, very little asset availability in that realm. And I'm sure it's the same way where you are. So that would be a great investment strategy long-term in Eastern Idaho.
Yeah. The costs are a lot to build the smaller ones, like all the big industrial space, right? All that vacancy I was telling you about, that's, most of these buildings are 100,000 plus. You get the economies of scale and the construction costs, and you can make it work. So the small ones, we're starting to see more of these people that are doing it, and they are meriting these lease rates that are $1.10 up to $1.40 a square foot. It's like, okay, it can pencil. So that is an option. My answer to that question, I think Idaho being a growth market, there's going to be more people coming in here, more businesses coming in here. There's a reason why all these investors and developers are looking at Idaho, because the long-term trajectory of Idaho is good. So just a blanket statement there. But I just go back to just real estate 101. It's location, location, location. So if you have a nice product, but it's not in a good location, whether it's the office, like say there's certain pockets of office that are going to do well. It doesn't matter what's going on, right? There's going to be a flight to a good located. Same thing with retail, industrial. If you have those amenities, those access and those type of things, visibility, just the opportunities all around. And I think there'll be more opportunities coming up with pricing coming down, people with the pain points. But just make sure you kind of get something. Someone said a long time ago, if you buy something, just make sure are you fine having it be vacant? Always ask yourself that question. Only buy something that you want, that you can be fine having it vacant.
Sorry. Brian, what do you think about strip retail?
Yeah, that's obviously a shameless plug, but I've been in retail for 22 years. I've traveled the nation to try to develop it, and it's been the redhead stepchild for some time. And the reality is the retailer is the most dynamic kind of business. They learn to change things inside of cycles, not just at cycles. And if you look at the valley, we've been at such low vacancy that the hindering thing has been the cost of dirt. The multifamily craze really drove up land construction costs. But if you're a landlord of retail right now and it's well located, you have pricing power. You can raise rents, and you can probably raise them pretty significantly. It's still tough to build brand new, but I do think if you have well located, shadow anchored retail opportunity that's there, I think it's worth pursuing, at least seeing if you have an option with your land to do that. And we're about to see, a bigger wave. We haven't seen a big center really be constructed other than Orchard Park. That's been mainly driven by Winco's owner-user position there. But I think you're going to see a number of owner-users in the next 2 or 3 years really pop up that people weren't expecting to see. There's a number of them that are talking and have been venturing into the market to try to find those locations. And the Central Valley Expressway will be a big addition to retail as well. You're going to have an area that didn't have, it does have traffic out there, but it's going to have a huge amount of traffic that's going to dynamically shift for, guys like you and I. We make fun of Jim for living out in Eagle, but all of a sudden his commute's about to get a lot shorter when he can go west. Funny enough, when he leaves his house, get on the Central Valley Expressway, connect 84. It's much different than driving the surface streets down Eagle or Shendon or something like that. So I do think there'll be a lot of opportunity in retail over the next few years.
Jim?
All right. Go ahead, Skip.
Just one area that we're kind of involved in, it's not in Boise, but it's at this point, we acquired a fairly good-sized parcel up in the Wood River Valley, is kind of new and innovative ways of looking at workforce housing, affordable housing. And I mean, there's just so much demand, and in places like that, it's a crisis. So we think there's some opportunities there, both from an economic standpoint, plus without being over the top, try to make some difference. The others agree with George and others. This downtown Boise is an anomaly relative to most other downtowns, but we're big believers in that, and we think there's continuing opportunity in downtown. And we talked about outside investors, like this apartment project at 12th and Idaho, that attracted some really strong outside investors who really, like all of us, I think, believe in the Boise market and particularly in the future of downtown.
All right, I'm going to answer that question really simply and say that the best place to invest is to come by 755 West Front Street, number 300, Colliers' office. That's all we needed to say, other than Skip, of course, on his property. But with that, I'd like to thank the panel. They're going to take their seats again here. We've got just going to hold your attention for a couple more minutes, have a couple of quick thank yous and an announcement. And so thank you very much to our panel and to Skip for all of the terrific information today. Quickly here, I don't know if Terry is available. Hopefully she's around and can come help me. There she is. It takes a lot to put these together, as everybody knows. I mean, this is a big event, and so I want to make sure that I take a moment to call up our marketing team. Last year they ghosted me and some of them hid. They didn't want to come up, but Jen, Lexi, Amanda, Haley, if you're hiding out there someplace, and obviously our team leader, marketing director, Amy. I want to, if you guys come on over here. A thank you to all of them for putting this on, all of the graphics, all of the information, the seating, working with the Boise Center. We couldn't do it without you guys, so thank you so much for putting on another wonderful Outlook event. And grab your flowers. Also, one more time, want to thank all of our sponsors. And I did not mention earlier, and I should have, would like to make sure I thank Freeform, who provides us our furniture on the stage every year. So thank you to Freeform. Thank you to all of our presenting and cooperating sponsors. And now what I want to do is, this is our 20th annual Outlook. Outlook was started 20 years ago by George Iliff. And if anybody knows George, they won't be surprised to hear this part of the story. George had worked with another group here in town who puts on a big symposium and wanted to have Colliers sponsor it and be a part of it, and they said no. And George said, that's terrific. We're going to start our own event. And he started the Outlook Conference. 2004, I went through our server and pulled up some old documents. In 2004, we had 80 people at the very first Outlook, 27 of which were Colliers employees and spouses. And look how it's grown over the years. Our marketing team has put together a brief video here that I just want to show, if we can cue that up, with a little bit of the history of the Outlook Conference. Welcome, everybody, to the 2020 Colliers Outlook Conference. As everything with 2020, we're doing it a little bit differently. I noticed a couple things there. One is, gosh, that was awful in the pandemic. We were all sequestered in our own offices trying to do a virtual conference, but Amy and her team pulled that off well. I also noticed it was nice to see some senior year high school yearbook pictures of Mike Christensen and Jimmy Romanis up there. They've aged just a little bit. With that, I want to call Amy back up to the stage and take a moment. George, if you could come up to the stage as well, please. As I mentioned, George started this conference 20 years ago and has seen it grow from, as I mentioned, about 80 people to, I think today we had over 600 registrants and people watching virtually. And George, we just wanted to say, thank you. We wouldn't be here without your efforts, without your determination to keep the conference going over the years. And Amy's got a trophy for you with every logo from the 20 different years of Colliers Outlook conferences engraved on the trophy. And we look forward to our 21st Outlook conference next year. I'm just teasing.
I just have a half an hour's worth of comments, if you don't mind. Well, thank you very much, Jim. It's an honor to be recognized, and it's been such an honor to be part of this community and part of Colliers. Mike Christensen is the only individual who's here before me, and we were a pretty grim crew when I first came here. And we've grown and we've done so much with each other, for each other, and in the community. And I couldn't be prouder of the success that we have as a company and the success we have as a community. And owe a lot of that to all of the folks that I've worked with in the past. And I would say that Jim's just done an amazing job of taking over and being the succession plan for the company. And we have just many years of great growth ahead of us with you at the helm, Jim. So thank you all very much. Thank you.
Thank you, George. And with that, I would say that we look forward to seeing everybody next year, October 30th, for our 21st annual Outlook Conference. Andy Badia has promised he will be there in his Halloween Taylor Swift costume. So something for everybody to put on their calendars. Thank you, Andy, for being here. And again, finally, to our sponsors, Givens Pursley, Washington Trust Bank, Land Pro Data, ServPro, and our co-sponsors, A10 Capital, Bus Mechanical, Centimark, Crane Alarm, Cutting Edge, Infinity Signs, Syringa Networks, and TradeStar Construction, as well as our furniture sponsor, Freeform. With that, thank you for coming. We have a cocktail reception, hors d'oeuvres, in the back and an opportunity to grab anybody individually if you have follow-up questions. We appreciate you all being here.